housing finance was part of what led to the run-up, the build-up of what we now know were artificially inflated home prices and home values. There was what I like to call kind of a black hole effect coming from the financial markets, from the bond markets. There was this endless appetite for mortgages to be packaged up. And that created this demand coming from the very high capital markets finance level, not from the level of actual value in actual homes where people are living in, but a demand for just the mortgages to be packaged and sold. The problem was that encouraged us to put a lot of debt on housing, on homes. And the more we put on, the more home values went up, because if you can borrow more, you can spend more to buy the house. And that was part of, not the only thing, but it was part of what led to that great run-up in home prices that, once the bubble burst, was a drop in home prices. When you get a sudden drop in asset values like that, that's part of what can really dampen economic activity and change people's perceptions about what the future is going to look like, where they should put their money, what they should be doing. So housing finance was part of it. We lost some discipline, right? People stopped lending against homes in a way that was tied to both the home's value on the market as well as the ability of someone to pay the mortgage. And they focused just on the value side of it. And when you start making loans just on that value and you assume that values will always go up, you just keep lending more and more. When we think about the home mortgage finance system, at some level, almost everything is on the table right now. We're at a point in time when there is both need for and appetite for really re-engineering the system. So some of that is at the level of capital markets. Think about Fannie Mae, Freddie Mac, FHA, right? The systems we use to take capital from the rest of the world and major financial institutions, investors in the United States, and channel it into loans for homes. It's also at the level of origination, right? The folks who make mortgages, the local banks, the local lenders who will originate a loan that would help an individual person buy a house. Great Recession and its aftermath, the housing crash, have woken us up to the fact that we need to have better channels and more reliable channels of capital from that top level all the way down to the level of the home mortgage. And of the things that are in play, one is the future of Fannie Mae and Freddie Mac. Another is the level of federal government involvement in guaranteeing those capital flows. How much security investors and borrowers and lenders will have that the federal government will backstop the securities that are created. We're also looking at changing the baseline requirements for who can get a loan. And that's some of the stuff that worries me the most about, if I think about the next, say, 10 years or even the next 5 years. The question is our reaction to the very loose lending that went on to say that, okay, only people with pristine credit and a lot of assets and high income can get mortgages because we know those are safe? Or is it to be, wow, we should make sure we're using safe lending products and responsible underwriting criteria so that we can still make credit available to a broad group of people who can be responsible borrowers without endangering the whole system? So if I look 5 or 10 years out and I say what kind of mortgage products are going to be available, because we had a buildup of some pretty creative or complicated or confusing, depending on how you describe them, mortgage products, I think we're going to get back to our roots. The 30-year fixed rate mortgage is an incredibly useful, powerful tool that most people can understand, and most people already do understand because they've had experience with it, their parents had experience with it, their neighbors, right? It's a known quantity. It's also a pretty safe thing. If you sign on to a 30-year fixed rate mortgage, you know what your payment's going to be. Some other things may fluctuate. House may need a roof, you may need to repair the driveway, you need a new water heater, fine, there's some amount of variation. But you know your main housing cost is fixed for 30 years. That's incredibly valuable. One of the things we learned from the crisis and the failures in the lending and borrowing that went on were that complicated loans or loans that have unsafe features, we really shouldn't allow. If I look out 5 or 10 years and I think about where the home ownership rate has been and where it's going, I would say we are, the one thing we're not likely to be is surprised, which is unusual. Usually I expect if I look 10 years out, I'll be surprised because I can't see that far out ahead. But if we look historically, the home ownership rate hasn't fluctuated all that much. We've seen some declines recently, right? It went from 69 and now we're below 65%. That's not, I mean, it's a big change in terms of what we've seen in the past, but it still means roughly a third of the country is renting and roughly 2/3 of it is in an owned home. Okay, we're not going to see a massive shift over to rental housing. We're not going to see a massive increase in home ownership. We will probably see a slow bounce back from the declines we've seen. A demographer could tell you more about that, certainly, but the key will be to make sure that there are the financial products people need in order to regain that home ownership, and that there are the right financing tools to allow us to create the rental housing for that third of the country that has historically rented and will continue to rent. The changes will be around the margin. So when you see press articles about, we're shifting to be a renter society, we're shifting away from home ownership, take a deep breath, glass of water, and recognize that the shifts are more marginal than they are systemic. So rental housing is critical, right? This is the way that folks of modest means, low and moderate income folks, find a place that they can afford to live and work in the communities that we all rely on. So when we think about what happened with the housing crash and what it revealed about our housing finance system, we should also think about the rental side of that. On the ownership side, we saw a lot of weakness, right? There was poor underwriting, values went up higher than they should have, the system was not designed to react properly, and it didn't react properly. On the rental side, we maintained discipline. This is the untold story of housing finance, is that the rental side worked and is still working, and the only reason it's still working right now is because Fannie Mae and Freddie Mac are continuing to run their rental multifamily platforms the way they always were. It's the part that hasn't seen any losses. The default rate, just to give you an example, on the multifamily businesses for Fannie Mae and Freddie Mac is well below 1%. It's been that way throughout the recession and the crash. Those numbers are way higher on the homeownership side. That's where all the losses are. When people talk about the bailouts, it's paying for the single family side. It's not paying for the multifamily side. What we need to do is make sure that as we redesign the system, we don't break what's still working, and we make sure that there is a reliable supply of capital. Remember that upfront money we talked about, to help build and preserve rental housing so that we have it in the places that need it. One of the challenges we're facing right now is to make sure that there are reliable flows of capital, upfront money, to help create and preserve rental housing, affordable housing, in the places where there's a lot of economic activity, where there's jobs, where there's services, where there's transit, the parts of cities and more bustling suburbs where there's a lot going on, where people are starting to move back in and want to live. If we don't have some way to channel capital from the global capital markets into that development and that preservation, it's going to be more expensive to do, it's going to be harder to do, there's going to be less of it, and the housing is going to be more expensive. And that's our big challenge with multifamily, with rental housing, is to make sure that as we're fixing the housing finance system broadly, that all the stuff we do for home ownership doesn't disrupt the parts that are working for rental housing.